Asset size has always been important when you're thinking about growth, either organically or through acquisition. But Dodd-Frank, for the first time, set specific asset size thresholds above which additional requirements apply. And so, for example, at $10 billion of assets, you have substantially higher requirements from a regulatory perspective than below $10 billion. Same thing above $50 billion of assets, you have substantially higher requirements than below $50 billion of assets, and the same with $250 billion of assets as well. So for the first time, you really need to think about asset size of your combined organization if you're going through an acquisition, or you need to think about growth if you're growing organically, and decide whether you've got the systems, whether you've just addressed the profitability issues, and you've addressed the compliance issues of going above one of those 10, 50, or $250 billion asset size thresholds in growing organically. Before crossing a threshold, one of the $10 billion asset threshold, $50 billion asset threshold, or $250 billion asset threshold that Dodd-Frank currently imposes, we advise banks to really think about two fundamental things. One is, do they have the systems and the compliance regimes to make sure they can comply with the heightened requirements at those levels, at the heightened levels of the new threshold? Secondly, and relatedly, they need to think about whether they are prepared to deal with the profitability issues, the enhanced burdens on their profitability that crossing one of those thresholds entails. For example, once you cross above $10 billion of assets, you are now subject to enhanced stress testing requirements, enhanced oversight requirements on the compliance side, and on the profitability side, you're subject to the Durbin Amendment, which limits your ability to charge interchange fees. You become subject to regulatory limits on interchange fees, which has been reported, some banks results in $7 to $10 million losses per year of interchange fees. And the question you have to evaluate when you're thinking about crossing one of these thresholds organically or via acquisition is the benefit of crossing over the threshold worth the burden of these additional compliance and revenue issues. So if you're a bank with less than $500 million of assets, what you really need to think about before you cross over that $500 million asset threshold is your ability to raise capital, particularly if you have a holding company structure. If you're less than $500 million of assets currently, the Federal Reserve Small Bank Policy Statement allows you to raise capital from a variety of sources, including debt, certain levels of preferred stock, and other types of issuances with greater flexibility than once you cross above $500 million of assets, which can obviously facilitate your growth, both organically and through acquisitions. The good news potentially on the horizon there is December 18th of 2014, Congress passed a law that instructs the Federal Reserve to raise that threshold from $500 million of assets to $1 billion of assets. So hopefully by May 18th of 2015, which is when the Federal Reserve is supposed to put that law into play, that new policy into place, these banks will have the ability to grow up not only up to $500 million, but up to $1 billion, and using this enhanced and alternative capital such as debt, preferred stock, and other types of issuances, and continue to grow that way before they run into issues which will now be at above $1 billion of capital. If you're a bank approaching $10 billion of assets, and you're deciding whether or not to cross that threshold, you have a number of considerations to think about. You have stress testing, which is going to begin. You're going to be forced to do stress testing annually. You're going to have the Consumer Financial Protection Bureau, which formerly has not been examining you, starting to examine you, and they are an enforcement-oriented agency. You have to think about whether you're prepared for that. You have the public company. If you're a public company, you have the requirements for a risk committee. And so you need to think about whether you're going to set up a risk committee and start to deal with that. And then perhaps most importantly, you have the implications of the Durbin Amendment. The Durbin Amendment is a rule that limits your ability to accept interchange fees. It puts a cap on your ability to do interchange fees. And for many of our banks around that size, it can have a significant impact, between $7 and $10 million a year, on their annual revenues. So crossing over the 10 is a significant hurdle. That's the first of the Dodd-Frank significant hurdles. Other ones are at 50, other ones are at 250. I think, though, the thing to keep in mind is the 10 is clearly the hard cutoff, but you also need to think about what happens around there. So, for example, if you're a bank of $6 or $7 billion of assets, and you're thinking about growing, you're thinking about doing an acquisition, or you're going through rapid organic growth, Perhaps you want to consider whether some of those, like the stress testing, some of those rules might be appropriate to start to put in place now to show the Federal Reserve, to show the OCC, to show the FDIC that you are prepared to move on to that next level of compliance, that next level of rigor. It's not good to just say when you're going to cross 10, we're going to put all this stuff into place. You're much better off ahead of time showing them you've started to adapt, that you have a risk-focused system that's starting to adapt and put more sophisticated compliance systems in place as you begin to grow. Similarly, as you move ahead and move past 10 billion, certainly at 10, 12, 15 billion, you're probably fine with the systems at 10. But you start getting larger and larger, you then start to want to think about the stuff at $50 billion. What the enhanced requirements for a $50 billion institution. Again, they're not technically subject to you. You're not technically subject to them. But at the same time, you have those rules in place that are best practices for you if they're requirements for a $50 billion institution. You always want to show the regulators you're staying one step ahead. That as you're growing either rapidly, organically, or planning on acquisitions, you want to show them that you are preparing yourself for that next level of oversight, which will give them the comfort they need to approve and move forward on your application.